Hey everyone, today on the final bar, my guest is Doug Busch from ChartSmarter based in the New York area. Doug's going to share with us take on healthcare and look at some individual stocks that are getting on his radar this week. Also, we're going to have a segment called Commodity Corner where we focus in particular on the commodity complex. If you look at this month, commodities have been number one relative to all the other asset classes. So let's dig into some of the themes with gold, oil, and broader commodities, see what we can find. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's show, The Final Bar. Thanks for joining us. My name is Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Every day after the close, we're breaking down the price action from a technical perspective, try to make sense of what we're seeing using the charts, and then connect what we're seeing today, the short-term movements with the long-term trends. And as we're looking at things, we talked yesterday about this market that distributed right into the close, this heavy sell-off on the S&P, pushing us lower. And then today we sort of gap higher. It's sort of long and strong. Everything's fine, getting better. So there's this yin and yang in the markets in the last week. And I think that's where I've heard legitimate analysis draw the conclusion of S&P 3600 and others saying S&P 2600 or lower. And so, we're at that decision point. We're at that sideways trend, that choppy sort of consolidation where everyone, I think, feels a little validated. Also, everyone feels a little uncertain. So we're going to dig into some of those ideas and see what's actually moving today, how that fits into our longer term picture that we've been painting together. I did want to point out some of our guests coming on the show. We have a great guest today, Doug Busch, who I've known for a number of years, does a really, really good job and uses the StockCharts platform, to be honest, better than I do, which is why I'm mostly impressed to have him on. Also tomorrow we have Kim Sokoloff as a fellow CMT based in the New York area. She does a lot of work with institutions, so I'm excited to hear her take on equities right about now. Next week we're going to take Memorial Day off for the long weekend, but I did want to point out Behind the Charts, which is our interview style show, will feature a conversation on Monday with Joe Duarte. Joe's a former anesthesiologist who got into investing and did a really good job. He wrote things like Idiot's Guide to Trading Options for Dummies and other books that you may have seen, but a really interesting story about how he transitioned from medicine into the financial markets. And then coming up next week, we have on Tuesday, Katie Stockton from Fairlead Strategies. On Wednesday, Ryan Dietrich from LPL Financial. So we are bringing out the big guns. We are bringing out the best experts we can find to help us break down some of these charts together. So really excited to have all of them on the show. Let's move on to our market recap. So as I mentioned, yesterday was an interesting one because if you look a couple days ago, 3 days ago, and I'll look at the intraday chart here for the last week. 3 days ago, we sort of had this breakout, right? The break above out of that bull flag pattern, and I mentioned in a couple places how that measures. If you follow that as a bull flag pattern, you consider that a valid breakout. It measures to 3,600 or so on the S&P, and that's what Craig Johnson from Piper Sandler a couple weeks ago had sort of mentioned that as his upside objective for the S&P 500 for the year. So it was interesting that those levels started to line up a little bit. But what we talked about was you need the confirmation, right? You have the breakout. The next day is where you get that confirmation, you get that validation. Yes, that wasn't just a random thing. This was a follow through. We have the confirmation that was the new direction, but we didn't get that yesterday, right? We sort of finished in a position of weakness. We finished below the open, finished down, selling off right into the close as things wrapped up. Today, we gapped right back up. We got above the high from 2 days ago. So I think if you're looking for, some upside signal that, that follow through, I think you could argue today we sort of got it. So, what that means for the chart of the S&P, and then we'll get to some of the other updates. I think, for me, I have to acknowledge the trend. And for me, that tactical time frame, if we're looking a couple days to a couple weeks, that time frame for me is all about looking at the highs and the lows. And as long as the market makes higher highs and higher lows, the trend is positive. And that is not debatable. That is based, that is what the market is saying. And so I think in the last couple days, this week, we've pushed above the previous swing high. I think that tells me that the trend is up. until proven otherwise. And again, all we need is a lower high, a lower low, that reversal. And that's why I think, last week it sort of felt like, there we go, there's the lower low, but you can see how this now has become more of a bull flag pattern, which means a big run, a corrective pattern, and then a breakout. For me, I mean, the real signal that I think you need to be thinking on the long side, primarily if you're not already, is a break above 3,000, which would put us above the 200-day moving average. That would, that's about as significant as a move I think you can see. And from a technical perspective, there's really nothing left until the February high, that 3,400 level. Now on individual stocks, it's a bit of a different picture. And I think that's what's interesting with something like healthcare, right? You're approaching previous highs. With a lot of stocks, you're sort of approaching those January or February highs. And I think that's a significant resistance level to eclipse at the stock level. But it does tell you, as a broad market, that things are continuing in a positive direction. You have to recognize that. One of the people were asking me on, I think it was on Twitter, on YouTube, basically saying they were struggling with this current market and missed the V bottom. And what I pointed out to them was, it's okay to be wrong. It's not okay to stay wrong. And I think by looking at these trends, by looking at the charts, that's where you can make sure you don't stay wrong. You don't stay in a losing position well past where it's healthy to do so. So the S&P closed about 1 2/3%, just above 2970. Mid caps up a little more to 1688. Small caps up over 3%. So it was really led by the smaller size of company. The Nasdaq 100 is up over 2%, right about a 2% as well, to 9485 on the NDX. And the VIX is now back below 30. It's just below 28 actually. So again, the VIX was up to 80 or so, and now has certainly right size, gotten back to more of a traditional normal range of sorts. We're going to talk about commodities later in the show, but I just want to highlight very quickly, bonds also finished higher. So again, as a reminder, I think a lot of people incorrectly assume stocks are up, bonds are down or something, because it's risk on, risk off. And remember, it's not always that. There are a lot of moving parts to juggle here. So the TLT actually finished in the positive. A lot of that came in the second half of the day after lunch, when it rallied up. So the 10-year yield down today. Gold also finishing higher. So it was one of those kind of everything up sort of days, which are nice to have because we haven't always had those recently, but it certainly was, across the board, sort of a rising tide lifts all boats, and that hit not just equities, but other asset classes as well. In terms of sectors, oil was up pretty good today, and so energy led the way up almost 4% higher, and that led the S&P sectors, followed by communication services. Financials are actually a really interesting one up here, right? We've looked at the chart of the XLF and the chart of Wells Fargo and others that have really chopped around, but are coming off these really depressed levels and have underperformed for quite a while. So interesting to see on a day like today that they rallied very nicely, and then tech was number 4. All 4 of those sectors up 2% plus today. On the downside, healthcare, the weakest sector, still up just a little bit, but sort of a rounding error above 0. So that was the lowest returning sector, followed by utilities, real estate, staples. So, besides, in general, there was sort of offense at the top, defense at the bottom. Some notable exceptions were consumer discretionary, which really weren't at the top of the list, but held up okay. And then something like healthcare at the bottom, and some of the biotech names and others have been great leadership stories, and they in general, as a sector, lag behind in the market today. When thinking about the overall market movements, I always want to think about the breadth picture and get a sense where we're at. This is one of the indicators we've looked at. And again, it's not quite updated for today's close yet. The S&P close is here. So now finally closing above that 61.8% retracement level to 2970. But I also wanted to point out just the breadth. So, sort of the base case we talked about was coming out of the lows, you have this pattern of higher highs, higher lows in the cumulative advanced decline line. So that's showing you this overall appreciation in the breadth picture. But then you can see how they've all broken down in the last couple of weeks. You've now had lower highs, lower lows. That mirrors what we saw with the S&P sort of in that short-term correction move. So what I would want to see to really sort of confirm and feel good about the market going materially higher from where we're at now is an improvement in the cumulative advanced decline line. I want to see a higher low put in place. We've not seen that yet. It's still sort of in a short-term downtrend, breaking down through the trend lines. The S&P clearly has gone above. What the breadth picture is going to tell us is if it's a narrow move with some of the mega cap names buoying the overall market, or if it's a broader appreciation in stocks, and that's why these indications will be very interesting to watch. I also wanted to point out, just in terms of the new, the advancers decliners, it's one of the breadth measures that we've looked at, and I just wanted to take a minute to focus on what they were telling us, because what we had in the last couple of days, we've had some a 90% update, depending on how you measured it. I measure it just on advancers and decliners as a percent of the total New York Stock Exchange listing. So it was just below 90%. This is on Monday's session. If you look at it from a volume perspective, though, it actually did get above 90%. The up-down volume was over 90% positive, which tends to be a fairly constructive pattern. Today, we were a little bit higher, but kind of came off a little bit. So 80% of New York Stock Exchange listings finishing up on the day. In general, uptrends are made of a pattern of these days. You can see the clusters of the cluster of days where you had 80, 90% of stocks up on the day. That tends to happen in bull phases, doesn't tend to happen in bear phases. You can see a random occasional pullback day where you had 80, 90% of stocks down on the day. But overall, you want to see some improvement in this measure, have it more on the positive side. And that's what we're potentially seeing this week. It's feeling like, from that measure of breadth, at least, we're going to new highs, and we're seeing a number of stocks sort of participate in there. So from here, again, from a big picture perspective, stocks in a short-term uptrend. I think that tactical uptrend is in play now. We're right at that key resistance level. S&P 3000, I don't think could be any more important in terms of, are we able to eclipse that or not? But continuing to see higher highs in price, I think you have to believe the upside is palpable. We're going to take a quick commercial break. Back with my... Hello, everyone. Welcome back to the show. This is Dave Keller here at StockCharts.com. Thanks for joining us for the final bar. As a reminder, a couple times a week, we do a mailbag segment. We get so many good questions from many of you with visual aids, with charts, asking questions, and we'd love to help you out. So just shoot us an email, thefinalbar@StockCharts.com, or on Twitter, just tag us in a post at FinalBarSCTV, and we will take a look and answer as many questions as we can in our next mailbag segment, most likely Friday of this week. Want to welcome on my guest, Doug Busch. Doug's a fellow CMT based in the New York area, founder of ChartSmarter. Doug, welcome back to the show.
Thanks so much for having me, Dave. It's always a pleasure to be on.
So we're in this situation. If you heard earlier, we're talking about this, this market that just continues to persist, this uptrend that just seems to continue. Every time we get a bit of a pullback, you get a corrective move, you sort of move higher. And healthcare, in a lot of ways, during this last 6 weeks, has been one of the better places to be. You focus a little bit on healthcare here. Can you orient us? What are you seeing, starting with a look at the sector?
Well, what I was looking at, as you can see this ratio chart here, I was kind of wondering, whether, we're always hearing this value versus growth question. And of course, it seems like value is perennially lagged growth. So I wanted to give it a shot, but I mean, it's as technicians, of course, seeing is believing. We need price confirmation. So here I was just looking at the XLV compared to the XBI. You can see the XLV is probably the weakest it's been in the last 6 months versus the XBI, although it is forming a bullish falling wedge pattern. But again, we need to see that type of, we need to see the breakout. Again, today, XBI up better than almost 3%. I think it was 2.6%. The XLV was on, so it's still telling you, as of right now, overweight capital to the biotechs until that's no longer the case.
And I love that point as a trend follower, right? I mean, that's clearly been the trend. If you look at healthcare, biotechs have just been fantastic. And so that, from your read, looks like that trend overall is continuing. Now you've shared some individual stocks that are kind of crossing your radar. Starting with Teva, what are you seeing here?
Yeah, well, with Teva here, you can see here, obviously it's an older play, a generic play. It kind of caught my eye. It's forming a cup. Now keep in mind, these charts are from yesterday's close, but it was just below a cup with handle buy point around 12.15. It kind of made me a little excited here. You see, for the first time in 6 months, both of this 50 and 200-day moving averages are curling upward. I'm a big fan of the round number theory. You can see this gap fill from the 5-6 session. That was the latest earnings report. Found support right at the 10 number. As the handle developed, went right back up. In fact, it's actually had 4 consecutive positive earning reactions, which is very positive. And according, with that 10 number, as I was saying, it's had 6 weekly closes now above that number, and all 6 were either below or right near 10 intra-week. So there's been some real nice defense of that 10 number.
Yeah, and an impressive relative strength coming out of the, I mean, even it bottomed out on a relative basis before the market did, right? I mean, bottomed out 3rd week in March and has been pretty consistent since then. That's a great chart. Chart number 2 was Perigo, PRGO.
Yeah, this one too, another name that's been around for a while, generic, just like Teva. This one is, this is the daily chart. If we were to take a look at a weekly chart, you'd see it's actually, hanging in pretty good there. It encountered a huge loss. I believe it was about 44% the last 3 weeks in December 2018. It had another pretty bad week, the end of February. But you know what? This one's hanging in there. And actually, it's had 4 negative earning reactions in a row. But you see here, I like how the last 3 weeks have really, it's starting to distance itself from the 200-day moving average. You can see here in March and April, that was a roadblock. So you see a nice defense of the 200-day moving average. Again, I'm a round number theory guy. You see at the bottom of the cup in March and April, the 40 number was supportive. In the beginning of the year, 60 was a slap in the face. You had two chances here to go above it, produced 2 negative candlesticks on 225, 226. But I think as long as it stays above the cup with handle, I think it can march higher toward that 60 number.
I just noticed a little stroke of genius of what you're doing. I assumed you were doing these relative to the S&P. You're actually doing it relative to the biotech ETF. So you're showing each of these healthcare stocks and how they're relative to biotech. It's a great way to think about it. Third is Takeda, T-A-K.
T-A-K, this one is a Japanese play. I hope we were pronouncing it correctly. But you can see here there's a nice bullish inverse head and shoulders pattern. It's had 6 consecutive closes. I have 5 on there. Again, today it closed above. So 6, usually, I like to see a pop above the 200-day, but again, you want to see 4, 5, 6 consecutive closes above there. I think that's a good area to play against. You have a measured move to 25. Obviously, if you measure the depth of the head to the neckline here of the inverse head and shoulders. And again, on the weekly chart, this has an add-on, and of course, leading stocks, they give you chances to add on the way up. On the weekly chart, you'll see a 20.52 pivot in a double bottom base that began last November. So, the longer the base, the greater the space, we like to say.
No, we only have about 30 seconds left, but I did want to show one last chart here because this is a name people may be less familiar with, Twist, TWST, but a little bit of a different characteristic on a relative, a nice strong relative to biotech.
It was. You can see there down again. I put a ratio chart up there against the XBI, which has been very strong. So you see, it's actually outperformed the XBI, which I just said has been very powerful. So that's a great sign. We saw a nice break above the bullish inverse head and shoulder pattern, and it formed again. Leading stocks will give you chances to add on the way up. A bull flag there above 40. So I think this move. I think the stock's going to grind higher toward the 50 number. In the near term.
Doug, those are some fantastic charts and a great take on healthcare. Thinking about healthcare as a sector versus biotech. Want to thank you for coming back on the show. Doug Busch from ChartSmarter. Doug, hope you stay safe and love to have you back on soon, all right?
Anytime you want me, Dave. Same to you.
That's Doug Busch from ChartSmarter coming to us from the New York area. And just I always appreciate people that can use the StockCharts platform just a little better than I can. That's why guys like Arthur Hill and Greg Schnell, Tom Bowley, Doug Busch, I always love watching how they're using the platform because I pick up a couple ideas as well. Our next segment is called Commodity Corner. And before we get to the chart of commodities, I just want to focus on a poll question we asked of you. As a reminder, we always have a poll running on the StockCharts TV page. So go to stockcharts.com/TV. We always have a poll running. Answer it anytime you see it because all that does, it creates a great dialogue between what you all are seeing and what we're looking at as a team, and gives us some really interesting themes to dig into together. The question we ask you, which asset class does better over the next 3 months? And I basically said rocks, scissors, or paper. Rocks meaning the GLD, hard assets. Scissors meaning bonds, and that's an allusion to clipping coupons, clipping the coupons on your bond certificate. And then paper, right? The paper assets like stocks. 50% of you answered gold. This is with a couple hundred of you responding. 40% saying paper, and only 10% taking a flyer on the bond markets, going for scissors. So it's interesting. You know, I find I'm always fascinated with something like this. What gets the least votes? Because for me, that tells you a theme that people are unprepared for if it starts working. And before we get to commodities, you know, the TLT is an interesting one. I get the argument that interest rates are very low. I get the argument that there could be limited upside for bonds. I get all of that. Having said that, bond prices could certainly go higher from here. And again, right now it's at 50-day. It's just started to break below it and now testing support around 162, 162.50. So if the TLT breaks below 162, I think that'll be sort of a concern. The RSI's remained above 40 as well. So overall it's holding in there, but certainly not getting love for many of you voting. 40% saying stocks, but half of you saying that gold is the best of the three. I was really interested to hear how many of you would vote for gold. So what we're going to do now for Commodity Corner, start with the broader commodity complex. We'll look at gold and oil, see what else we can get to in our limited time looking at the commodity complex. So when I look at commodities as a whole, you've got a bunch of different choices. And so up at the top here on this candle glance page, you can see some of the things I look at. The CRB is one of the more widely followed ones that only updates once a day. So I like to look at some of the ETFs that are going to update intradays. The GSG, the DBC, those are all ones that I've tended to follow. If we look at the DBC, this is the Invesco sort of broad commodities tracking fund. You know, what's interesting is after the big sell-off in commodities into mid-March, you then had the nice rally. So it rallied along with stocks going into the April peak, retested the low end of April, and now we're right back up to that peak, right back up to test that April high, which is why I think it's so interesting. Now, this is obviously oil is a big weight in something like the DBC, so stronger oil is certainly going to be probably the main thing to propel this higher. But I'd be very interested to see if we can transition from distribution to consolidation to appreciation. A higher high would sort of confirm that transition. It's back above its 50-day moving average for the first time since January, so it's certainly had a bit of a recovery here. The RSI is back above 60, which is more characteristic of a bull market phase. So given that strong move for oil out of the lows, it's certainly given a bit of confidence there. The GCC is another ETF. It's based on more of an equal weighted version. So instead of having a huge oil overweight, it's actually equal weighted across commodities. Interesting to note, you've had a pattern of higher lows for a little while there on the GCC. Also, you've already broken above that swing high from early April. So the GCC, the equal weighted version, which is going to give a little less weight to energy, a little more weight to hard, soft commodities and elsewhere, already has broken above its swing high. So suggesting commodities, if you take the huge overweight in oil, it's already sort of in a positive phase. Let's look at a couple of these in particular. Gold, in the form of the GLD, is right here. And again, half of you suggested out of those three asset classes, that was the place to be for the next 3 months. And as a trend follower, you guys get an A+ for capturing the right trends. Gold out of all of them is the one that's at all-time highs. It's continuing to make new highs in the last couple of weeks. Had this nice run. Everything sort of became dislocated in February to March, and gold, along with many things, sold off sort of, and then just sort of right-sized back up. The volatility came back down. We sort of had this consolidation pattern of lower highs and higher lows. This was in the second half of April into March. And then since then, has now rotated back higher. And now we just continue this trend of higher highs and higher lows. The concern, only concern I see here is the relative, which has been weak. So as gold sort of rallied into April, stocks were rallying much more. And so it was underperforming the S&P. But if you look month to date, it's actually outperformed by just a little bit. And again, making new highs while the S&P is not anywhere near it at this point. And it's getting closer, to be honest, by the day. But at this point, not near it. And gold has certainly gone higher. So I think you were totally valid to think of gold. And again, even if you're not, just thinking about a broader asset allocation, deserves consideration as a piece of what you're doing for sure, based on the trends. Now, oil is an interesting one. We'll look at the USO. And again, the crude oil future we'll look at in a moment. The USO is good just for short-term movements, just to understand supply and demand, a little more transparency that I've found. So I like looking at it. But over the longer term, there's a decay that's built into things like the USO because of the rolling of the future. So over the long term, it's better to look at crude oil as a commodity to get a better sense. But in shorter term timeframes, it's totally fine to use the USO. Here you can see this gap up a couple times, but again, this trend of higher highs and higher lows. And just like we saw with the S&P, if it's making that sort of pattern in the short term, I think you have to assume that that trend persists until proven otherwise. So with the USO, you're getting a bit of an uptrend here, higher highs, some gaps higher. And if you look at the crude oil future, which we'll look at here, this is the continuous contract going back. You can see it even almost looks more constructive because it takes that decay that's baked into the USO. You can see crude oil back above its highs from early April, and it's continued to appreciate. Energy has been one of the better places, and I think that's, this is the reason, because oil has round tripped so quickly from being in the single digits and some of the contracts going negative. My concern with oil, and where I want to just finish this chart, is if you look at what's happened, it's rallied so much, we're nearing that overbought condition. The last couple times it's been overbought, and again, I left all these lines just to show how compressed this range is relative to what we've seen since that sell-off so far year to date. But if you look, a lot of times we're at the upper end of that range. The indicator became overbought or very close to that. That usually was when oil was pulling back. So it's had an incredible run. I'd be a little concerned if it gets to that overbought region, expecting at least a little bit of pullback. And again, with energy, that might dampen the flames just a little bit on there. And just to finish off, I wanted to show you this this chart. My labels got all whoppers. I don't know how that happened. Sorry about that. But this is basically showing you the trend in commodities versus other asset classes just month to date. So if you start the clock on April 30th, I'll just visually go through this. Here's bonds down 1.3%. Here's the dollar essentially flat. Here's the S&P up 2.2%. Gold up 3.6%. In orange is the commodity index 7.4%. And here's oil up 33%, using the USO as a proxy for oil prices. So the three commodity-oriented things, the top gainers, and even gold has outperformed the S&P if you look at the last couple weeks, starting on April 30th. So remember, even though stocks have appreciated well, things like gold are actually doing just a little bit better. So some interesting themes to certainly pay attention to in the commodity complex. We need to wrap up our show, though, folks, and go right to the 3 and 3 charts. 3 minutes. Here we go. We're going to start with the high yield ETF HYG. This was not on a lot of people's radar. I think a lot of people use the TLT or other metrics to follow the bond markets, but when the Fed announced they're going to be buying the high yield ETF, I think a lot of people started watching the HYG more than they had before. That's this big gap up that you see on the chart first week in April into the second week in April. Since then, though, it went sort of way down, almost filled that gap from the peak swing high in March. Since then, has found support around 78 and now has gone to a new swing high, broken above the 80 level, which takes it above the end of April, the beginning of May, and now it's back into a short-term uptrend, a tactical uptrend, higher highs and higher lows. So while the TLT is still sort of back here somewhere, high yield debt, which is focusing on junk bonds, basically on more risky equities, is actually appreciating pretty well. And there are a lot of reasons why that chart can go higher, but I think it's worth noting the HYG making new swing highs. Second one is looking at semiconductors. Doug Busch was talking earlier about biotechs relative to healthcare and thinking of the relative performance trend there. I've always found semiconductors as a relative performer a great way, usually a leading indicator for stocks. This group tends to perform well during uptrends, during primary uptrends. And as you can see, we're just really close to making a new relative high. If you take the high from the end of March, we're almost above it, making a new relative high. And that would certainly be a bullet point on a bullish thesis for stocks as a whole. Finally, I have to just remind everyone, even though financials were up in the upper half of sectors today, if you look at the ratio of the XLF versus the XLK, this has been going down, and it's not just a recent phenomenon. This is the last, this is year to date. You can see it's really underperformed tech, but that's actually been going on for quite a while, really since the financial crisis. Overall, financials have been a much weaker part of the market. So again, until that chart would turn higher, I think it'd be really hard to justify when you're thinking about sector rotation to own something like financials over technology. Or if you do, it's got to be more opportunistic, more hunting and pecking for particular ideas as opposed to a sector allocation. I just don't see the trends necessarily justifying it here. Folks, that's our show for today. Thanks so much for joining us every weekday after the close for the final bar. Special thanks to my guest, Doug Busch from ChartSmarter. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.